Senator Patterson.
Thank you, Chair. Appreciate that. Governor, I want to ask you some questions about the recent monthly inflation prints. I preface that by saying I've heard you say many times that we need to be cautious about the monthly figures, that they're variable and that the RBA puts greater stock in the quarterly figures. But nonetheless, the two most recent monthly prints have been higher than were expected, and there's been a very strong reaction both from economists who use very strong language to describe last month's indicators, particularly calling it a shocker and other kind of language like that, but also a market response changing the expected time for the next rate cut from 100% probability in November, which is probably a bit too confident, now to less than 50%. So what do you think is driving the increased or higher than expected inflation in those last two monthly prints? So
caution again. You've got to be a little bit careful because monthly data are quite volatile.
Yep.
Depends on whether you're looking at headline or the trimmed mean. The headline jumped up, but there was some things going on with timing of energy rebates and so on. That's why we tend to focus on underlying. The other caution I would make is that trimmed mean in a monthly sense is not the same as trimmed mean in a quarterly sense, so you can't just read into the trim mean for monthly what it might mean for quarterly. Having said that, there was two components of so we do get a reasonably good read from the first 2 months of these monthly indicators on a couple of things, housing and services. And both dwelling costs, inflation, so that's the cost of building new homes, was a little higher than we'd been expecting, and inflation in services was a little higher than we had been expecting. So that's made us think that when the September quarterly comes out, that there is an upside risk to our forecasts in those, because those things are looking a little higher than we thought they would be.
And that quarterly data is out in late October, isn't it? I think days before your next...
the week before our next board meeting.
Yep. So obviously that'll be more indicative. What does this indicate more broadly about the fight against inflation? Is this just, in your view, the last mile challenge and it's just that last sticky bit to be defeated? Or is there a risk that actually the fight against inflation is going to be a more enduring, ongoing one, and that we have to be much more guarded about the upside risks here?
No, I think at the moment we'll do some more forecasts for our November meeting, but at the moment we think the risks are relatively balanced on both sides. It is possible that we'd been expecting the inflation for this last bit to be slower to decline than it came down very sharply and then it's been a much slower gradual decline. We had expected that, but as I said earlier, we're in a position where we think the labour market's maybe still a little bit tight or maybe close to balance, depending who you talk to. So if we get a strong pickup in growth, then it's possible that we've got a situation where growth is starting to pick up at the same time as inflation now is just back in the band and employment is being maintained, and in those cases there might be some upside risk. It's also possible, though, that what we saw in the June quarter with respect to consumption isn't maintained, and you've got all of this uncertainty associated, which I think the Secretary of the Treasury talked about yesterday. You've still got all that uncertainty out there with the international environment, China, United States. So you've got a balance on both sides. So that's why when the board says it's trying to be data-driven, it's trying not to preempt, it's trying to think about the risks, and it's trying to use the data as the data come in to inform where it thinks things will be going in the next 6 months or so. So that's why we do need to make sure that we remain data driven.
You mentioned energy rebates as part of the reason for the volatility in the monthly figures, and I think certainly in the July quarter there was a very obvious case. There was, I think, a New South Wales state government payment which was paid 2 days before the month or 2 days after or something, which had an impact on the data. But it's also true that, as you say, part of the big falls in inflation last year were driven by those energy rebates, weren't they?
Well, no. Some of the initial big falls from the peak weren't driven by that.
Trimmed or a headline? I thought that had a big impact on headline.
Well, headline coming down from 7.8. A lot of that was just across the board.
Oh, sure. I'm not disputing that.
So the last year or so, energy rebates have contributed, but I think the numbers are. I think 0.2%. I think is the amount that we've seen come off. So it's not massive. It's not like 1 or 2 percentage points. It's fractions of a percentage point, and so we'll be giving that back when the rebates come off. So you might get an uplift then. But
which is this calendar year. Those rebates are all starting to kind of.
Well, the rebates, the rebates at state government level have been coming off, and that's why you're seeing some of the inflation numbers go off as those come off, but the Commonwealth have been extended till the end of the year, so that will continue to subtract about 0.2 from inflation, and then when they come off, that will get given back.
Okay. You also mentioned the labour market. Obviously, there was the ANZ Indeed figures out last week, which are softer than people were expecting. How much stock do you put in that? Again,
it's just one indicator. We look at a range of indicators across the labour market. I'd say the forward-looking indicators like vacancies, job ads, notwithstanding that, we've seen them as being they wiggle, but they've been reasonably stable over the past 6 months or so. So we don't see again, I mean, it's 1 month's figure, but broadly it's been stable, but it is something that we look at.
The other data out recently was the Westpac data on consumer confidence, which took a big hit. Do you attribute that to the public's changed expectations about the interest rate pathway?
I don't think that the consumer confidence numbers have really recovered. I don't think we've seen them sort of pop up as interest rates decline, and as interest rates declined and then start coming off again. Consumer confidence has remained quite low, and I don't think we have a really good explanation for why, because certainly, as we talked about earlier, we are seeing people start to consume again, and they're consuming discretionary goods and services, not just essential ones. So there's a little bit of a puzzle about what might be going on with consumer confidence.
And it's not unique to us in Australia. It's a bit of a global phenomenon.
Yeah.
I agree with you that generally it has been low, but even from that low level, it fell even further. I mean, the Westpac Melbourne Institute index declined by 3.5% from September to October. That's a material decline. Any thoughts on the driver of that, if not interest rate expectations?
No, I wouldn't say so. I mean, as Chris just said, I mean, around the world we're seeing low consumer confidence, even as interest rates are declining here, even as we're observing that people are responding by consuming discretionary goods and services, their confidence is still low, and it's a little bit of a conundrum. We don't really know why that is.
Okay, all right. Thank you, Chair.
Thank you.